The U.S. economy is a complex system, interwoven with various sectors and influenced by both domestic and global factors. Understanding it requires looking at multiple factors, from production levels to consumer behavior. We consider things like how much the country produces, or GDP, which is a measure of the total economic output. We also look at how fast prices are rising, or inflation, which affects the cost of living for everyday Americans. Consumer spending and government policies play a big role too, shaping the economic landscape. Right now, the U.S. economy is facing some challenges, but there are also signs of strength and resilience. One of the biggest challenges is inflation, which has been persistently high. Inflation has been stubbornly high, eroding consumer purchasing power and making everyday goods more expensive. This means people can buy less with their money, impacting their quality of life. Another challenge is the rising cost of housing, which has become a significant burden for many families. High interest rates make mortgages expensive, making it hard for some to afford homes, especially first-time buyers. Despite these challenges, there are bright spots in the economy that offer hope. The economy is still growing, albeit at a slower pace, indicating underlying strength. The labor market remains strong with low unemployment rates, which is a positive sign. Consumer spending, a key driver of economic growth, is also holding up, showing that people are still willing to spend. Government policies are another important piece of the puzzle, influencing economic stability and growth. The Federal Reserve, the country's central bank, has been raising interest rates to combat inflation, a critical move in economic management. These rate hikes aim to slow down the economy and bring inflation under control, balancing growth and stability. However, they also carry the risk of triggering a recession, which could have widespread implications for the economy and people's lives. Gross domestic product, or GDP, is a broad measure of economic activity. It represents the total value of goods and services produced in a country. A growing GDP typically signals a healthy economy. However, GDP growth alone doesn't tell the whole story. Inflation is another crucial factor. High inflation can erode the benefits of GDP growth. When prices rise faster than wages, people have less money to spend. This can slow down economic growth. The U.S. economy is currently grappling with both rising GDP and high inflation. This presents a challenge for policymakers. They must find ways to curb inflation without stifling economic growth. This balancing act is crucial for maintaining a healthy economy. Wage growth is essential for a healthy economy. When wages rise, people have more money to spend. This increased spending fuels economic growth. However, inflation can quickly erode the benefits of wage gains. When prices rise faster than wages, people lose purchasing power. This means they can buy less with their money, even if their wages are increasing. This situation can lead to financial strain for individuals and families. In recent years, the U.S. has seen wages rise, but inflation has outpaced these gains. This means many people are falling behind, despite earning more. This wage inflation gap is a significant concern for the economy. Section 4. Housing market check. A seller's delight, a buyer's dilemma. The housing market is a significant part of the U.S. economy. It impacts not only homeowners but also renters and the broader economy. Recently, the housing market has been a seller's market, with high demand and rising prices. Low interest rates fueled this boom in previous years, making mortgages affordable. However, the Federal Reserve's recent interest rate hikes have changed the game. Higher mortgage rates make buying a home more expensive, cooling down demand. This shift towards a more balanced market is expected to continue. Home prices are predicted to stabilize and affordability may improve for some buyers. However, challenges remain, particularly for first-time homebuyers facing high interest rates and competition from investors. Section 5. Consumer behavior, spending habits in an uncertain economy. In this section, we will explore how various factors influence the way people spend their money, especially during times of economic uncertainty. Consumer spending is a major driver of the U.S. economy. It accounts for a significant portion of economic activity, influencing everything from job creation to business investments. When people feel confident about the economy, they tend to spend more. This increased spending can be seen in various sectors, including retail, dining, and travel. This spending fuels economic growth. Businesses expand, hire more workers, and invest in new projects, creating a positive feedback loop. However, economic uncertainty can make consumers cautious. When people are unsure about the future, they tend to save more and spend less. Factors like inflation, interest rates, and job security can all influence spending habits. High inflation can erode purchasing power, while rising interest rates can increase the cost of borrowing. When inflation is high, people may cut back on discretionary spending to afford essentials. This can lead to reduced sales for non-essential goods and services. Similarly, rising interest rates can make borrowing more expensive, potentially slowing down big-ticket purchases. This includes items like cars, homes, and major appliances. Despite these pressures, consumer spending in the U.S. remains relatively strong. Many people continue to shop, dine out, and travel, indicating a resilient economy. This suggests a degree of confidence in the economy. Even in uncertain times, the willingness to spend reflects optimism about the future. However, it's essential to monitor consumer behavior closely. Changes in spending patterns can signal shifts in economic conditions and consumer confidence. Changes in spending habits can provide valuable insights into the overall health of the economy. By understanding these trends, businesses and policymakers can make more informed decisions. Section 6. The policy landscape, government's role in economic stability. Government policies play a crucial role in shaping the economy. Fiscal policy, which involves government spending and taxation, can influence economic growth. Monetary policy, controlled by the central bank, manages the money supply and interest rates. The Federal Reserve, the U.S. central bank, has been actively using monetary policy to combat inflation. By raising interest rates, the Fed aims to slow down borrowing and spending, which can help cool down the economy and bring inflation under control. These policy decisions have significant implications for businesses and consumers. Higher interest rates can make borrowing more expensive for businesses, potentially slowing down investment. For consumers, higher rates mean more expensive loans and credit card debt. Section 7. Looking ahead, a balanced perspective on the U.S. economy. Predicting the future of the economy is a complex task. It involves a multitude of variables, from domestic policies to international events, all of which can shift rapidly. However, by analyzing current trends and considering various factors, we can gain insights into what might lie ahead. This involves looking at data from multiple sources and understanding the broader context. The U.S. economy is currently navigating a period of uncertainty, but there are reasons for both caution and optimism. Mixed signals from the stock market reflect this duality. Inflation remains a concern, and the Federal Reserve's actions to combat it could potentially lead to a recession. Their decisions are closely watched by economists and investors alike. The housing market is also adjusting to higher interest rates. This has led to a slowdown in home sales and a shift in buyer behavior. Global factors like the war in Ukraine and supply chain disruptions add further complexity. These issues have far-reaching impacts on trade and economic stability. Despite these challenges, the U.S. economy has shown resilience. Businesses are adapting, and new opportunities are emerging in various sectors. The labor market remains strong and consumer spending is holding up. This is a positive sign, indicating that people are still willing to spend money, which drives economic growth. Technological innovation and entrepreneurship continue to drive growth. Startups and established companies alike are pushing the boundaries of what's possible. A balanced perspective, considering both risks and opportunities, is crucial for navigating the economic landscape of the future. By staying informed and adaptable, we can better prepare for whatever lies ahead.